tough learning. I think a lot of folks who eventually have pulled the trigger on buying a rental property before, even with a property manager, is they realize that rentals are semi-passive at best.
Right.
And personally, I still think they play a really important role in wealth building. Like we will buy more rentals in the future at some point. But at this stage of life, like we have a couple young kids, man. Like we don't want to necessarily add overhead and stack more overhead on top and like limit ourselves. But
Welcome to Investing for Generational Wealth. I'm John Clive from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with investors, we're renovating over 1,000 multifamily apartments and building over 500 single-family rental homes, and we're expanding into private debt, industrial commercial real estate, and oil and gas ventures. Before we begin, as always, a quick disclaimer. We are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before beginning investments. Again, my name is John Lai. I'm your host today, and welcome to today's episode, 5-part framework to vet sponsors. Today's guest is Spencer Hilligoss. Spencer, do you want to give a quick update on what you've been doing and how you got to where you are today?
yeah, and thank you so much for the invite, John. Really excited to connect with you and also just share the journey. Man, it's such a fun space to be invested in over the course of the last 8 years. So these days, I lead Madison Investing. It's our investing club, along with my co-founder, who's also my wife, Jennifer Morimoto. It's kind of its own podcast about starting a business with your spouse. We consider it a strategic advantage in our household, but it's not for everybody. So these days, I look at investing with as much rigor and a vetting framework as I can, and that started long before we started an investing club. Really, I look at it like this journey in 3 parts. I was working in tech for 13 years. I know we were talking offline about this, but I was at FinTech for, basically a company called Intuit. Most people know that name. And then a bunch of Intuit competitors over the course of 13 years, leading operations groups, big sales groups, growth teams, et cetera. And eventually, we were looking at our 401k accounts and patting ourselves on the back for maxing those things out, feeling really good about income, dual income household here in the Bay Area, California. I live here in Alameda. And ultimately, we were just like, well, where's the off ramp from this? We have a couple young kids, like you and I were talking about up front. And in the end, there was a couple catalyst moments I look back at. And this is around 2016 to 2015 time, and just grinding as hard as I can imagine within early stage tech companies, and sitting there going, okay, why am I doing more hours nonstop? Why am I spending less time with my family? And there was a period of time where I think I spent 2 weeks without seeing my younger son because I was going in so early and coming home so late, And ultimately, that really was the camel or the straw that broke the camel's back, right? I devoured education, and I also was, led into my fifth and final startup that I joined. That was the biggest fix and flip lender for real estate investors in the country, and so that was a really helpful, pivotal moment because it opened my eyes to the economics and what's possible when you're doing real estate investing. And I'm not a flipper. I mean, the clientele of this company I was at was fix and flippers. I can't swing a hammer. So it lit the fuse though. And I went down the rabbit hole for this first phase to be like, hey, we have to allocate our capital differently. Like we have to just do something beyond the S&P. We have to do something beyond just maxing out 401ks. Something's got to give. And so we took all summer, scoured the Bay Area to find cash flow, which is not an easy feat. And that goes for whether you're sitting in, the coastal markets. I think you said you're up in Portland, John. Whether it's, coastal markets, East Coast, West Coast, it's tough to find cash flow if you buy a rental. But we took all summer with the kid in the car, finally found a rental and paid way too much for it to get $200 a month in cash flow. $430,000 rental, 100K down cash, not a cash flow win, man. And so that was a good learning for us, although it's appreciated a lot. That was a testament to lack of clear goal setting. And so we ultimately said, how do we stretch our dollar further? How do we go and like really make sure that if we're going to run out of capital fast, if this is our playbook to generate cash flow and generate passive income for our lives and our livelihoods over time. So we went to the Midwest. We looked for rentals that were more affordable. So we actually got up to a portfolio of five single family rentals, average purchase price, mind blowingly cheap for coastal market standards. We're talking about 60K average purchase price, and then cash flow that we got from those private properties were on average $250 a month. So like it's sounds great, uh, but then the tough learning. I think a lot of folks who eventually have pulled the trigger on buying a rental property before, even with a property manager, is they realize that rentals are semi-passive at best.
Right.
And personally, I still think they play a really important role in wealth building. Like we will buy more rentals in the future at some point, but at this stage of life, like we have a couple young kids, man. Like we don't want to necessarily add overhead and stack more overhead on top and like limit ourselves. But when if you're willing to sacrifice that extra 10% of revenue that you're going to get and pay a property manager, you still end up managing the manager. So we went through those first two phases, kind of like bought local, too expensive, bought long distance, sight unseen, which was super intimidating at first because you can't just be there all the time. And then we realized, oh, wait, these tenants also turn over way too fast, crushing your economics in one of these rentals. So we eventually found these passive investments, like investing as an LP. And I remember we like cut the first check. The first one we did as an LP was like just a 25K investment, and then we ramped up over time after that. But that first one really opened our eyes because passive is what we got. We wanted passive. We invested in a multifamily deal that was in Alabama. Within 3 years, we had doubled our money, and that's not what we expected. It was like a 7-year hold period, buying into a syndication with an experienced team, and we were like, oh, this is actually fully passive, with the exception of the upfront due diligence. I mean, it's not fun going that first time when we were investing in a syndication deal and saying, oh wait, I have to read this 200-page or 150-page legal document. This is hefty stuff. No matter how technical someone is in their career and how many times I've read contracts and partnership agreements and stuff in my corporate career, this is still new. And so, besides that, though, that was kind of the three stages of that journey that led us to say, well, we're going to lean into this more heavily. And so now, since really 2018, we have invested into multifamily, self-storage as the two main focuses, but we also branched out far beyond that. We've invested passively into mobile home parks, medical offices, you name it. Key focuses for us this year in the current market environment are number one, private credit and debt. So we focus on that as our number one because the interest rates are so high right now. It's a really favorable time for that. And we still love self-storage. So I think that those are just two big focuses for us these days. But yeah, it's been a wild journey, John. And I think that the one thing I don't often share in because I'm almost embarrassed by it sometimes is that like I grew up in a real estate household. Like my dad was a broker for 30 years, and so I technically got into the quote unquote business when I was like six. Because I was sitting there getting dragged around to open houses he was doing. And as I got older, I was working open houses for him and cleaning out fridges for properties that needed to be prepared, like stuff that was really scaring me into tech.
Right,
So,
right.
yeah, I look back very fondly on that time now in hindsight. But I would say, I do just have to mention briefly that a key learning that led me further down this path and kind of got my butt moving was my family, like watching my dad grow his business to great heights, like really, really big heights in our household growing up. Uh, he was a top performing broker nationally in the 90s. So we had a very comfortable lifestyle until went through a grim time, like lost my younger brother to cancer, lost a bunch of other people in our family during this dark decade. And I watched what happened when a one income household in our home goes away. And we had to downsize significantly growing up in my household. And I'm not going to make it sound like we were living on the street. It wasn't like that, but it was a big change. And I try to think about that now as a father myself and the steward of our household, and think like, how could I have avoided that? And how do I build a moat, like more of a true financial moat around our livelihood in our household? Because God forbid something happened to me, get hit by a bus, whatever. It's just key for me to take that responsibility seriously and figure out how do I solve for having that one active income scenario not happen. And investing is a path forward on that for us.
That's great. Thank you for that background. What I guess since the topic of this particular webinar is the 5 steps to vet an operator, what are the key steps that you see passive investors should keep in mind?
Yeah. When we first started investing as LPs, Jennifer and I put this framework together at the high level just because we didn't want to get burned. Like we didn't
Sure.
want to lose capital. It's one of those key cardinal rules. We can all chase a good risk adjusted return, but we don't want to lose the capital. So I'm a big operations nerd from my career, and I'm very comfortable with the spreadsheet. So we put it down on paper and simply said, these are the 5 pillars of this 5-part framework. You've got to look at number one, track record. Number two, approach. Number three, the team. Number four, comms or communications. And number five is values. There is a incredibly nerdy spreadsheet that you can look at that backs up all of these different pillars with like 70 rows of qualifying questions. But I'll just kind of give you a couple highlights as to the ones that I think are timeless, but also a couple, if we have the time, that are like newly refreshed and like enhanced since the last 2 years of investing. Because since the market's pulled back with this high interest rate environment, the interest
Right.
rates got raised faster in 2022 and beyond, faster than the past 40 years, with more faster and more severely. So the big overarching takeaway, if anyone listens to this and drones out afterwards and they're like, "This is too much," just remember this: it's like you got to look at the experience level of the team that you're investing with. Someone out there years ago, way smarter than me, came up with the notion of like, I invest passively in real estate. I have to look at the team, the market, and the deal. But what they don't emphasize is that the team dynamic, the who, is 90% plus of the risk mitigation efforts that you can have up against a passive investment, right? So when we look at track record, if I invest in a self-storage operator, I want to see that they've actually done this before. Not only did they buy that type of facility, they're familiar with the markets they're buying it in. They're familiar with like the business plan they're going to run. And I would say they also know how to put together a really smart exit strategy.
Mm.
Like
Yep.
exit strategy is everything, and like having the ability to say, yeah, I can go buy this property. I can go, pull together a team of whether it's construction experts, whether it's asset management, maybe it's vertically integrated in-house, maybe it's third party, whatever. But if they don't have an idea of what the heck am I going to do to have someone else buy this piece of real estate at the end, well, then it's all for naught. So it's,
Right.
it's a major risk. So I'd say track record is definitely the big one. The one big change in risk assessment from before and after, like 2022 and 2023 rate increases, I would say, is it's surfaced a lot of the gaps for some of the sponsors that look at, like, you have a great track record on paper. They might have, a bunch of really impressive IRR, like internal rate of return. They might have 2 dozen different properties they bought and sold. But if their track record has relied on the incredible moment that was 2021's valuation pops, it's not a bad thing. But what it does mean is like, I want to look at the approach, and that's the number two of the five. Approach, simply said, means, is there a repeatable business process behind what this team is doing? Like, if they've done this before, they can articulate it in really good granular detail on paper and in just walking through it in a conversation with you. And I think about it like, if I'm learning a new song on guitar, because I noodle on the guitar sometimes, like if someone asks me, how'd you learn that song? That seems tough. Like, I'm not a savant. I have to practice a lot. Like, so I can walk through, it took me these steps over this time, and that's specifically what I did to get there. Same idea, but applied to, these wonderful, wonderful, best kind of boring assets that I like to invest in real estate, of like, cool. That's the plan that they ran. So the approach is married very closely with that track record and the way that we look at it. But I'll take a pause because it's easy for me to nerd out and get excited about these things, but I don't assume everyone is.
No, those are great. And I would encourage those that are listening, watching, if you have any questions, feel free to drop it into the Q&A or drop it into the notes and we'll get back to you. Um, with regard to experience, do you require that an operator have had a full turn, meaning they've bought, but then they've actually sold to make sure that, they're, and then multiple times, not just like the one-time experience, but that they've done it multiple times just to show some consistency and or show that they know how to manage an operations and be able to dispose of the property.
We do.
Yeah,
Yeah, it's essential. And I am one of those guys who actually is open-minded to emerging sponsors, who are categorically just newer in the game. Um, However, there has to be something full cycle on the track record that we can see. Earlier in my investing journey, I did invest with some sponsors who were earlier in that journey, and I actually want to be very encouraging on this comment. I think that the market at large benefits by more people entering who have the right intention, right? And they're going to put the work in. But it's too complex of a game, I think, for the folks that are doing that work. If I'm going to trust them with my $100,000 investment or $50,000 investment, they have to know what they're doing, And I think that one thing I will say though, is that there's this term in qualifying question we put in called failure response, and very similar, for both you and I who come from kind of corporate backgrounds. Like I think of this from like an behavioral interviewing perspective. If I'm interviewing and talking to a sponsor, I don't get I don't get fully scared away if they have a blemish. And this is one of those things that I'm told is controversial. I really don't think of it that way. Like when it comes to passive investing and alternative investments like this, like um, people think, oh, they had a deal that went bad, therefore I should never invest with them. I am very much the opposite perspective on this, which is like I want to have a sponsor that I'm going to ask a question, say, give me a good answer on like tell me about a time. Tell me about a time when a deal didn't go well. Like what happened? What was the root cause of it? Like walk me through how you dealt with it. Because in the end, sound judgment and even keel temperament is paramount on this stuff. Everyone loves, to my more technical brethren out there in the tech community, most of our fellow investors in our community are from FANG companies and tech abroad. And we love a spreadsheet, man. But I will say they can actually be quite misleading because in the end, the numbers on a great looking pro forma, nicely formatted in a spreadsheet, looking at a T12 trailing financials for a building, that has nothing to do with telling you what is this GP going to do when something significant happens, a weather event that could not have been forecasted, an act of God, a historically fast interest rate hike that no one had in their forecast. No
right,
one had a forecast of 300 bips basis
right,
point increase in interest rates coming. No one did. And so what happens then? So it really comes down to I'd rather be deploying my capital with sponsors who have been through something kind of excruciating on the business front and ideally on the real estate front, because in the end, stuff does happen. It's, true to that Mike Tyson quote of everyone has a plan until they get punched in the face.
right. Well, to that, and what's a good reaction? What's a poor reaction from a GP or a sponsor?
Yeah,
It doesn't have to be
this
like
has happened. Oh,
yeah.
sorry.
And I was gonna say it doesn't have to be an actual like a real use case. But if it were, what's something that would be interesting to see and like red flags.
Yeah, for sure. The real example, because it's happened before, is just saying there hasn't been one. Like asking like what has gone wrong and saying nothing's gone wrong. That tells me one of two things: either they're too inexperienced and they haven't hit the moment yet, which is bad, or they're not being forthright. They're not being honest,
Right.
and
Right.
which is the kiss of death for due diligence, right? And,
Yeah.
and in the end, that has to be, it's going to be one of those two answers that are not so good. And I want to jump over, if I can, John, over to values. I think that this is one of those same, related topics. It sounds so darn squishy. And my heart goes out to the folks that are looking at vetting from a pure quantitative perspective, because I am sure you're sitting there going, values? I can't run analysis on values. It'd be like, well, this is why great due diligence, in my experience now, having been partnered into over 50 private placement deals in the alternative asset landscape at this point, is that, I mean, you absolutely need to blend the qualitative and the quantitative in your due diligence. And asking like, for example, on multifamily, love multifamily as an asset class. And if I'm talking to a sponsor, we're all capitalists here, like totally get it. Like we're here for, investing our capital, watching it grow, generate cash flow. But if the asset that's generating those profits has human beings, like families that live in the units, then I want a sponsor to ask to have an answer to this question that I'll ask them, which is like, hey, sponsor, can you walk me through your philosophy on tenant experience, like the living experience you're trying to provide for people? And I mean, candidly, John, like we've had one example where the sponsor, we were so far along in due diligence on this sponsor. They had good deals, strong experience, focus in markets we like, great business acumen. And I could not get an answer for the life of me
Hmm.
on that topic. And like, if I getting to know someone, I'll ask kind of the same question multiple times just to give them a chance, and it's not like a hardcore interview where I'm saying like, you're going to hire you for the job, man.
Right,
It's,
right.
it really is a sense of partnership. That's why it's called limited partner. But he didn't answer it, and we walked away
Yeah,
because in the end, it's like different context. If it's a self-storage facility, there's no one living in the units ideally, right?
right.
But if it's a living experience, that matters. I mean, I have to mention like Wall Street Journal had a piece that was I think in 2022, back half or maybe early 2023, after the interest rate spikes, and it featured probably the most publicized multifamily debacle. It's like the Apple's Way debacle in Texas, and it was one of multiple kind of heartbreaking scenarios where you had people living in these apartments and the sponsor was not fixing basic things like windows and HVAC.
Right.
This is real seasons in Texas, and like there's families sitting there. And so I've sit there and I'm like, see, that is the most extreme example I can bring up. Like there might be interest rate problems that caused that portfolio deal to explode, but there was a much, much bigger, more fundamental problem of neglect and not focusing on a good tenant living experience.
Yeah, I like that. Thanks for that anecdote. Um, I think we went through three. Is that correct? And then let's
Yeah.
talk about the
Yeah.
other two.
Sure. Yeah. I think let's talk about team. I think on the team, what this really means is that sometimes a GP team or a sponsor will have like one head person and their, CEO, principal, whatever however the title goes. Sometimes they'll have two, three, more than that. And my before and after learning, having gone through so many of these deals at this point, is that it is essential to have more than one. And for a number of reasons, but I'll just share a couple. Like, first and foremost, there's this idea of like key man risk, where if you have one person, life happens. And if you're in a 7 year, 5 year, these illiquid deals for that period of time in a fund, a syndication, whatever, what happens if something happens with an individual, diagnosed with a sickness, like something severe? So it's ideal to have two. And to take it a step further, ideally you want to get a sense of, are these partners ready for business marriage? And they're not dating. And a lot happens over the course of a 5 year period. That's longer than college. It's longer than undergrad, And so uh, in that time, like we've been invested in deals where one of three partners decides, you know what, I think I'm done with this chapter of my life. I'm going to go and hit my boat and just hang out there, and you guys got this covered, right? And so that gives me so much pause. Uh, Ideally, you see a team that has been working together for a good course of time, and they're there on that team for a reason. Like they have an area of expertise that is complementary. This isn't every time, but the configuration I've seen, which I'm supportive of, is like you've got a visionary leader type of role, CEO. You've got a person who owns the numbers, like truly CFO end to end. Then you've got another person who might be like, maybe they're going to focus on construction, or maybe they have the deep expertise on asset management, you know, whatever that configuration. But I think on the team front, man, does that matter. And there's some basic table stakes stuff that I'm not mentioning, but I'll just make sure it's plain for folks because I don't want to breeze by this on the hard vetting front. When you're vetting the team, I mean, of course, you're doing civil background checks, criminal background checks. Like I do those things now, religiously, and thank God, like I've never had an exciting report. Like that's like you don't want an exciting background check to come back, you know. But all that to say, like you want to take a look at that basics on that stuff. I never previously leaned into looking at things. This is controversial, but you have to look at the balance sheet, like the financial wherewithal of the company that you're investing with, not just the deal, like the company. And we've taken it a step further now because we've said, what about the sponsors themselves as individuals? What are they betting on this one deal I'm investing in to put food on their own table? And are they going to rely on subsequent deals and fees and stuff like that just to fund their lifestyle? Again, like comes all the way back around to this idea of sound judgment in the hands of like a capable sponsor. Like they can have skills galore, but if they are feeling in the crosshairs financially, and they're like, I have to make this deal work or else, oh my gosh, that is a fully jeopardized judgment.
Right.
So like we want to see ideally with a sponsor that has personal financial wherewithal, and they meet like on the most recent fund that we put together. Like right now, we're doing a feeder fund into a private credit fund. Right now, it's going really well, and we did our full due diligence process, and I made sure like are all of these GPs meeting qualified purchaser standards, right? And which is just if that's a new term for folks, I know they can Google it, but that just means they have millions of dollars in investable assets and to be able to deploy. And I didn't used to ask that type of question early on in my journey because I thought, how is this related? But I've seen some crazy stuff happen in this market, and when people's judgment starts to get compromised. And so on the team, I think that that's really like really pivotal. And other ancillary teams go into not just the GP, but does that company have infrastructure? Like do they have a staff member who's a controller, a financial person? Like, are they able to provide professional level communication? And that's kind of a bridge over to the final of the five is like, let's talk about communication. Like communication in 2025 should not be rocket science. It comes down to, like, can a sponsor put together a clean email update? And I want to see before I put my money into a sponsor on a deal or a fund, like, hey, can I take a look? Like, can I take a look at some of these other deals? Like, how do you communicate? And not just the updates on the fund or on the deal itself, like, hey, we've renovated this many units, or we've actually finished completion of this build out. It comes down also to financial performance updates. Like, is there a cleanly formatted performance update on the financials from last quarter? That it sounds so simple, but it's pretty elusive sometimes in real estate. I'll give a real example. We just got to know, but ended up passing on like a self-storage sponsor. We worked with three in the past, and we were about to work with a new one. Great team, like very experienced, competent, know the real estate in and out. But this is tough when you have to walk away because of one specific real reason. And the real reason was I got the financials from a couple of deals in their portfolio that were recent, and it wasn't really that legible. And like, I'm not the guy who's going to sit there and hyper analyze. Oh, this spreadsheet is using Helvetica font on here and Roboto on row 5. Like it's not about that. It's more about, are they putting together something that has like at least baseline professional polish? It's legible and it tells that story via the numbers, because that does speak volumes. It speaks volumes on the competence and the internal standards that they keep as a company. And uh, probably last but certainly not least is like examples of how they've provided bad news. And bad news happens, man. For example, the last couple of years, like if anyone has been investing regularly and enough zeros into private equity, like you've probably been investing in deals, and I have, where I've had my distributions paused because interest rates spiked,
Mhm.
right? And when stuff that's bad happens, a experienced LP just wants to be talked to like an adult. We want to just be told, here's the bad news, and here's what we're doing about it in a timely manner. you know, and I think that that part of it is fundamental in corporate world, in real estate, and in just good life, in general. And being upfront with people, I think that matters a lot. And people and adults can handle it, but what we can't handle is like uh going ghost on folks,
Yeah.
and frankly, just um, hiding anything intentionally. So those are some of the big things that I think give me pause. But of course, I'm sure people are sitting there who've done investments like this before, probably wondering why isn't he talking about fees? So let me just talk briefly about fee structures and stuff. Of course, we look at all those technical basic stuff. Like we look at the fee structures, making sure they're within market norms. Like is if someone's taking an acquisition fee, usually there's acquisition fee on a syndication deal, asset management, disposition fees, are there are sometimes a couple others, but are they within range? Are they reasonable? Like in the end, a fee is there for a reason. Like
Mhm.
sometimes, like I shake my head sometimes or scratch my head when I see passive investors saying, "I can't believe they're taking fees," and it's like, well, how the heck do you think they're doing this work? This work?
Right, right.
it's like
Mhm.
come on now. It is excruciatingly brutally hard work to go and buy a 200 unit apartment community. Not only capital intensive, but they have to fight tooth and nail to go win these deals. So sponsors should be financially incentivized to do well, but not just on the front end. Also, so important to look at the structure of the profit split, the waterfall. And, across the market, so many of us have seen hundreds and hundreds and hundreds of deals that have something like a preferred return, a profit split, or, if something like a 70-30 LPGP split, something along that. And perhaps like a hurdle of some sort where if it hits performance that's good enough, then it goes to like another split type of like 50-50. And so making sure that those are just reasonable and balanced. And in the end, they incentivize the right behavior, because you don't want to be 3 to 5 years into a deal and have the sponsor not have a financial carrot to continue executing on their job and executing on the business plan. Hence, you know, seeing it through to the end, man, like all the way through a great exit. Like you want them to be motivated to outperform. And so it just has to be mentioned. Like, of course, the fee structures matter and the incentives and making sure that those things are there as well.
Yeah, that's great. Thank you for that. With the changing political environment, frankly, political and economic environment, how has that changed, or has that changed how, the five step vetting process that you have?
Oh, that's a good question. Not directly, but I will say a couple at the federal level, not so much, with the one exception of we're big fans of finding depreciation and bonus depreciation. So there's always a possibility that there will be some new tax codes amended or passed in the near future that would maybe bring back more bonus depreciation. I would be very for that. Um, but I would say that on the municipal level and the state level, uh, keeping a close eye on just the regulations as it relates to building new real estate, what types, as well as I am keen to invest in markets and states and cities that are more owner friendly. Of course, I'm sitting here in California, probably the least friendly, along with New York,
Right.
for real estate investors because there's just an imbalance, on landlord and owner and versus tenant laws. But I would say that's the other one. I look at like um, those who invest in like Airbnbs, like we were watching like a hawk what was happening in like New York maybe like a year ago, I
Oh,
think,
that's right.
yeah, and they were passing some of the regulation that would outlaw Airbnbs at just short-term rentals. These are examples of like just getting a pulse on local markets, state, municipal, and otherwise. But federal level really just would be great to see some more tax-friendly stuff coming in the near future. And I'm saying that apolitically, we're just talking about tax code. So that's something we look at.
Okay, good. I know we're at almost the top of the hour. Some of the questions we like to ask our guests are one, what, I mean, you learned quite a bit throughout your years in investing. if you were to go back to yourself 10 years ago, what advice would you give yourself?
Oh man, it would be like this phrase above all else, John. There will always be more deals.
Right, right.
You know,
Mhm.
it's a deeply emotional thing to deploy a sum of money that has 5 digits or 6 digits in it, and especially on the first one. And so I challenge folks to sit there and really wrestle with this question. And this is a question now I tell myself on 100% of the investments that we look at, which is what's the goal for the money? You know, it sounds really simple. In practice, it ain't. Our lizard brain, my lizard brain kicks on the moment that an investment summary comes through, an offering memorandum. It's got beautiful pictures of this asset sitting in a great looking high growth market. It's got tax benefits. It's got returns. And I sit there and I say, okay, wait, like Jennifer and I are talking, we're like, what did we earmark this 100K capital for? Are we allocating this for cash flow or are we allocating this for growth? At its simplest level, that really helps bring it back to center, you know, because in the end, like there will always be more deals. And like it's very emotional when like I see a deal come through and it's like, well, geez, that IRR says it's going to hit 28, 30% within a 5 year period, but there's no cash flow, pure growth deal. And it's like, well, what happened to that whole discussion we just had about putting 100K into cash flow?
Yeah,
You know,
right.
it's tough, and that's why that you have to think of goal setting and due diligence as a holistic picture. It's not just about the raw quant.
Right. Now, do you in the two cases, cash flow versus yield, do you um, invest out of certain types of accounts, such as like a retirement account, as the IRA, for example, for a cash flowing entity, like the private debt that you
Mm.
are considering? Do you invest it out of a retirement account or like a tax benefit account?
Oh, great question. So yeah, so for context, I had four leftover 401ks from the tech companies I worked at. I mean,
Hmm.
classic, you
Yep.
know, year and a half, 2 year runs across a bunch of tech companies, right? So I had four 401ks. I opted years ago to consolidate them into one. I shopped around for what type of self-directed retirement account I wanted for our setup. Like I'm not prescribing this for people. Like this worked for us, but I'm a big advocate for at least look into self-directed investing. I think it's well worth it. So I use a solo 401k, and I've invested in I think 13 deals with it at this point. And I absolutely consider my source of funds, as it were, right? So if I'm investing for cash flow, investing with cash, like not retirement funds. Investing with retirement funds, you can go and say, "Hey, I'm okay with no cash flow coming back." But it just really depends on the characteristics of that unique deal, of course. But
Yeah.
it's such a powerful way to go and invest, and I'm so pleased with the performance. I'm just knocking on wood that you know we've been treated well investing that way so far.
Can I double click on the investing for cash flow?
Sure,
Whenever I think about investing for cash flow, I always think, taxes because you get the cash flow and you have to pay taxes on it.
sure,
Granted, a 5 year multifamily in the fifth year, whenever the year of disposition is, there's a huge tax hit, right? A
yep.
clawback of depreciation and the like. But for cash flow, I had always assumed um, cash distribution, you get tax on it. Is that the wrong way of thinking about it? And that's maybe too much minutia, but
No, I mean, not for me, John. I mean, I like talking about this stuff. I mean, as a guy who used to work at Intuit, I thought that I would never be interested in taxes, even though I worked for the company that did like a third of the country's taxes each year.
right.
Um, so I have found the depreciation benefits and passive losses that come with these investments for us very powerful. You know, and the example being, you know, you get that Schedule K1 tax form every year if you invest. And, you know, it depends on on what type of asset you invest in on that given year, on how much bonus depreciation is federally available still. But in the end, it's been pretty powerful. Like I get you know, do a 100K investment or a 50K investment, it comes back with a Schedule K1 form and it's showing like a passive loss, the good kind of negative number on there. And that helps defer and offset the cash flow distribution or the tax I have to pay on those distributions. during that hold period. And I mean, the thing that I sometimes see that's incorrectly categorized on some forums, I think still, is that, people might say, oh, but you can't use it against the capital gains when you exit the deal. Well, that's just categorically false, And of course, I'm not a CPA here. I'm not giving tax advice. I'm speaking from my own experience, having gone through this a bunch. And like, it's super cool when you get good depreciation losses on a deal. You don't lose them if you don't use them. You just have to file correctly, have a good CPA. And then when you exit that deal, to exactly your point, John, like you're going to have to owe some long-term capital gain and you're going to have to owe some depreciation recapture tax, those two types. But you're going to still have hopefully some losses to offset that tax obligation so you can defer further, and that's just really powerful. I mean, of course, everyone and their mother out there, particularly within our larger tech community, wishes that it was a silver bullet, the timeless question of, well, can I use those to offset my W-2 income? And the answer is a resounding, of course not. But if and when someone wants to
Right,
go
right.
and yeah, and become a full-blown real estate professional, then that's a different story. But yeah, I digress.
The other question I typically ask our guests is, uh, think of a investment that didn't go as planned. Uh,
Sure.
and maybe you talked about your single family rentals, or but besides that, like in the multifamily world, or
Mm.
like your capital allocator investments, what maybe early on did you invest in that you now know
Mm.
that you could be doing better?
Yeah, I think there's a couple dynamics at play right now in the market, and this applies in multiple states, multiple operators. So it has impacted performance on a couple investments in a material way, which is working with that sponsor and having them truly start to consider the impact of climate. And this is just to be clear for folks, this has nothing to do with politics. This is a climate conversation. So the insurance premiums are real. The risk of rising insurance premiums is very palpable, particularly if you're looking at coastal markets in the Southeast and hurricane lane, right? So that's one. Like, just make sure they're factored into the pro forma. Like, if the deal pencils with an escalating insurance premium in there, great. If it doesn't have that factored in, major risk. Um, the other one would be taxes, and that would be like property taxes. In a couple states, like we've been in deals that are otherwise great deals, good piece of real estate, good sponsor, but they, in their initial pro forma assumptions, like I should have pushed back harder to be like, wait a sec, are these high enough? Like, are these tax increases for property tax high enough? So those are just kind of those universal kind of variables across different asset classes and markets and sponsors. But those are real, man. I mean, those costs are not insignificant.
Um, Last question I think we have for today, which is how do you give back to your community?
Yeah, I mean, a couple of ways, like more directly, just, I always try to be a resource. I don't charge for consulting or anything like that. We don't charge a membership fee for people to join. So what I do is just be a true coach to the best of my ability and soundboard as folks are like putting together their strategies, but also just want to get my feedback on opportunities they see as they come through, like pro bono coaching. But one of the other ways is that actually Jennifer, my better half and co-founder, she sits on a board of Bay Area financial literacy for youth, and so we aim to be charitable, and that not only means with like our time, but also we give back, with philanthropy, financially and otherwise, and so those are just some of the ways.
Great. Well, thank you very much, Spencer. And that's all the time we have for today. If you have other questions for Spencer, how can they best reach you?
Yeah, no, this has been wonderful. So thank you so much, John. I appreciate you having me on. People can reach us at madisoninvesting.com. They can request an invite and just chat with me. They will have to have a conversation with me at some point, though.
Perfect. Perfect. Again, thank you very much for the time, Spencer, and time out of your busy schedule. Don't forget to like and subscribe to our podcast on whichever platform you're listening on, to make sure that we can continue bringing you the best educational content like our conversation with Spencer. Thanks, everyone. Until next time, keep learning to invest for generational wealth. Thanks, everyone.